Thanks everybody for staying until the last session. I hope it will be an enjoyable session, especially enjoyable talk. So this work is joined with Rizej Ha, who is a graduate student at Columbia, a brilliant graduate student. You should get a chance to talk to him if you have not done so yet. And the work is basically discussing about the adoption of blockchain-based exchanges. And it's in the context of DeFi. So let me get started with the talk. So I basically want to first give a brief introduction to decentralized finance. I think many of you already heard about decentralized finance, especially given the session yesterday, and also we had a talk this morning about that, which is essentially a new form of financial intermediation. So the key characteristic is that everything is happening on blockchain, and it's using smart contracts. So smart contracts, which are open source, the code is visible to everybody, and these contracts are basically used to implement financial transactions. So at the moment, like DeFi is offers a very broad range of financial services, ranging from borrowing, lending, intermediation, and swapping transaction, etc. So the key point is that you don't have anymore the classical intermediary or the middleman who intermediates between trades, but everything is happening in a decentralized fashion. So now, how large is this industry or these services? I mean, I think it's growing more and more. This is like the last snapshot that we have taken at the end of earlier in the last fall, which is basically covering the period from July to September 2021. We see that it's like a 66.3 billion in terms of total market cap, including several services. The focus of this talk is really on decentralized exchange, which accounts for roughly half of the entire amount traded on the DeFi service. So it's like also a market which has reached about 1.28 trillion in exchange volume. So it's really growing more and more. Just to give you a ballpark figure to estimate, you can see that like if you compare it with the NYNC, NYNC has recorded at 1.1 trillion volume in December 2021. So it's really comparable in scale to the volume that is traded on the classical financial exchanges. And if you look at the exchange, typically you have two types of exchange, decentralized and centralized exchanges. In the case of crypto trading, we see that the intermediation happening through the decentralized exchange is still a small percentage compared to what you see in the crypto centralized exchange, but it's growing, and at the moment, it's about 10%. So it's really a non-negligible amount. Now, I want to discuss what is the key mechanism about decentralized exchange. So the key innovation is really the fact that liquidity is a pooled resource now. We have, let's say, taking into just as an example, Uniswap pool, which is one of the largest decentralized exchanges. We see that there are liquidity providers and liquidity miners. So the liquidity providers, what they are doing is depositing tokens into the pool. So what they do basically, if I have some token, for example, and I want to deposit this pair, I can do that. If Will wants to do that, he can do that. So everybody is able to do that. What matters is only that you deposit in the ratio given by the current state of reserve. So if you have 100 token A, 10 token B, if somebody wants to deposit 10 token A, he has to put 1 token B there. And then the liquidity providers are not really competing with each other, but they are sharing this resource. So they are essentially pulling together tokens, and then there will be a risk sharing. They're sharing the risk and as well gains and losses. And then if investors want to trade, these are the liquidity demander, they can go into the Uniswap pool and they can swap one token for others in accordance to the price that is determined by the pool. So that's like really a neat alternative to the classical way of exchange, which is basically selling one of the crypto token for a fiat currency and then using this fiat currencies to purchase the other token. So you directly exchange one token for others. So how does liquidity provision, as I mentioned, works? I already briefly said the main point is that if you have 100 token A and 10 token B, if I want to deposit, I have to deposit in the ratio of reserves of token A and token B that I have in the pool. So if I have 10 token A and 1 token B, I can go to the pool and deposit this token. So the pool will have 110 token A and 11 token B. And then in return for depositing, I will get some share of the pool. For example, if the pool had 40 liquidity shares and I deposit 10 token A, 1 token B, I hold 1/11 of this entire pool. So that means that I will get 4 pool tokens. And that's essentially how I can claim share, how I can show that I'm a shareholder in a sense of this Uniswap pool. Okay. Now, the next important characteristic is how does the pricing works. The pricing is determined by essentially a function or an algorithm implemented by the smart contract, which maintains a certain invariance property. So the idea is the following: suppose that you have a certain balance of, let's say, Bitcoin token and a certain balance of Ethereum token. Now, what has to be true is that after depositing the tokens, or after swapping the tokens, the relation has to be invariant. So that means that if the function that is implementing the smart contract is the product function, which is the one implemented by the MM in Uniswap, and is basically given by the product of the contract balance of token A and the contract balance of token B. If I want to swap 5 token A for some token B, I have to make sure that after the trade, what happens is that the amount of token A that I have in the pool times the amount of token B is equal to this constant K, which in this case is 100. So that means that if I deposit 5 token A, I basically can only get back 3.3 token B. I cannot back exactly the same amount of token B that I have in the pool. So if I have an initial ratio of 10-10, you deposit 5, so the number of tokens in the pool becomes 15, and you get back only 3.3 token B. And this is basically showing the so-called slippage phenomena that you have. So that means that your trade has an impact, and this price impact is captured exactly by the convexity of this pricing curve. Okay. In addition to liquidity provider, I mean, the investors, the reason why they basically they want to trade is because, of course, they may have preference for holding one token versus the other. But what incentivizes liquidity providers to deposit? The fact that any investor or any liquidity demander will earn a trading fee. So, for example, if you want to trade and swap 10 token A for token B, you also have to pay a fee which is proportional to the amount of tokens that you want to exchange. And this fee is basically used to create additional token A, which will be deposited in the pool. So that means that the share, the amount of token A that the liquidity provider will be able to claim when he leaves the pool will be larger because of these fees that are being paid by the investors. Okay, so that's essentially the reason why the liquidity provider wants to deposit, because they will be able to make profit by gaining the fees. Okay, so I think everybody here, or most of you, already know how blockchain works, but I just want to mention the basic mechanism that the miners, who are the entities in this ecosystem which will execute the transactions, will be making profit from the fees that will be paid by investors or arbitrageurs or anybody who wants to trade. So that's the idea of the blockchain, and this is essentially what incentivizes miners to execute transactions. Now, what are the main characteristics of the decentralized exchange, which are also very important to understand the result that we have? There are 3 main features that are really critical and crucial to explain also what type of trade-off is faced by the liquidity providers on this exchange. The first is that blockchain settlement works in the following way. So once a transaction is included, then there is an instantaneous settlement. So there is no real difference between settlement and clearing, right? Settlement is instantaneous. And before the settlement, the traders are completely retaining the full control of their tokens. So they have the full ownership of those tokens. Now, liquidity pooling is the other important characteristic. Any token holder can be a provider of liquidity. And what it does is deposit its tokens, and then he earns the fees from the investors, but they are sharing this pool. So it's like really sharing it, which becomes the key point. And the third important point, characteristic, is that the pricing function is deterministic, so there is no need to match buyers with sellers. You interact directly with the smart contract, which means you interact directly with the pool, and you can exchange token for others. So there is an immediate access to liquidity in this decentralized pool. So now, what does this paper do? What is the main contribution? The main contribution is that we have the arbitrageurs, which are, as I will explain, critical to exploit price deviations between the decentralized exchange and what is happening outside of the decentralized exchange. and they are extracting rent from the liquidity providers. And the reason why they're extracting this rent is because of two important characteristics. The first is that blockchain, the order processing mechanism, prioritize that transaction. So what matters is not which transaction is submitted first, but rather which transaction is paying the larger fee. Okay. And the second important characteristic is that there is this liquidity pooling design, which means that each liquidity provider is only holding a share of the entire AMM. It's not holding the entire AMM. Okay. So what are the consequences of this problem? That because there is this arbitrage rent, then this is raising the cost of providing liquidity. And as a result, there is also a negative externalities imposed on other users of the same blockchain because of the gas fee surge. The fact that the gas fees are raising due to these arbitrageurs which are running for first execution. And after we basically identify the concept of this problem, we propose a remedy to this problem, which is essentially the one of constructing a pricing function where we minimize the impact of the arbitrage rents on the liquidity provision. So how can one minimize or mitigate to the extent possible this large or this potentially large arbitrage rent, which is extracted from the liquidity providers by the arbitrageurs, and as a result, incentivize liquidity providers to deposit more. Okay, so these are the three main points. I want to quickly prove the literature review. I think many people, there are a couple of papers that have been written on DeFi, like mostly looking at front-running arbitrage, and the other is comparing centralized versus decentralized exchange. There is also, like this paper also connects to a broader literature on market microstructure, especially like to what you have like in centralized limit order book in terms of sniping risk. And also, of course, broadly speaking, connects to the large literature on the tokenomics, blockchain and cryptocurrency, like for instance, the paper by Fahad, the paper by Wheels, the paper by Michael, like they all contributed to this literature, but like in a different sense. So let me go and describe the model. We have 3 periods, 1, 2, and 3. And we have 3 types of agents. We have a liquidity providers, so many liquidity providers. There are 2 arbitrageurs who are competing for execution of this arbitrage, and then we have many investors that wants to trade. Like we position ourselves from the point of view of an automated market maker, we send like a couple pairs of tokens. So we use A and B to denote the token pairs that will be traded, and there is no symmetric information, so everything is publicly observed, and the prices of token A and B, or the fundamental value of token A and B, are visible to everybody. Okay, so everybody knows these fundamental values, which might change from time to time. So, and I will explain how they change. This is how the model works. So time 1, the liquidity providers are choosing their portfolio, so they are deciding how much to deposit and if they deposit. The second period, there will be a random event happening. Either the token prices will be subject to shocks, or an investor will arrive, and an investor can be a type A or type B, depending on whether or not he likes to get hold of token A or of getting hold of token B. Time 3 is when exciting things happen, like there are arbitrageurs which will be able to exploit, or which will try to exploit 2 types of arbitrage. One is the stale price arbitrage due to price deviations between the spot rate within the automated market maker and the fundamental rate outside of the automated market maker. And there could be also the reverse trade arbitrage, which can be exploited by the arbitrageurs after an investor has traded. So in both cases, there will be this competition between the arbitrageurs who want to exploit the arbitrage opportunity and the liquidity providers who want to prevent that, and they will try to exit. Okay. So the pricing function that we are working with is like a general convex pricing function. So we are not really restricting ourselves only to the constant product function, which is implemented by Uniswap, but it could be any convex pricing function. And if you look at the AMMs, like the different AMMs, Balance, Curve, SushiSwap, they all implement a different pricing function, which follows in this category of convex pricing function. In the paper, we have more properties of this pricing function, but essentially what matters is the convexity. And importantly, the algorithmic property of this function has to be exactly this equality. So after trading, after depositing token A and taking out token B, the value of the function must remain the same. So that's the key invariance property that is typical of automated market maker. And now you can see easily from this curve, like a straightforward application of the implicit function theorem basically shows that the the exchange rate, the infinitesimal exchange rate at which you exchange token B for token A is given by the ratio of the derivative of the function at X and at Y evaluated at the current value of the reserves, which is YA and YB token. So let me go and now describe what happens at period 1. So the liquidity provider are solving the following optimization problem. There are n of them. They are endowed with a positive amount of A and B token. So each liquidity provider is choosing how many tokens of type A and type B to deposit in order to maximize this objective. Okay, so they want to maximize the objective, which is if they deposit, then they will basically see what is the value of their token YA and YB at time 3, which means after the shocks have happened and after like the price of the tokens might have changed, and they will basically then claim a share WI of this entire pie, okay, at the end. So if they deposit, then the amount of token A and B will change because of many events that will happen, which I will describe, including arbitrage exploitment. If they don't deposit, that means that this is the amount of XA and XB of token that are not deposited into the AMM. Then they will just observe what is the price, and this will give them a profit. And of course, in order to deposit and in order also to compete with the arbitrageurs, they will have to pay a fee. So what they want to maximize is benefit of depositing minus the fee that they have to pay for having deposited. Of course, subject to the conditions that the deposit have to happen at the prevailing exchange rate in the pool. So now, at time 2, there will be, as I mentioned, 2 events. There could be a shock to the price of the tokens, or there could be an arrival of investors, which could be of type A or type B. So for the price shocks, we are assuming that basically this is a shock to the fundamental values of the tokens, and this is called by independent Bernoulli shocks. So like at random, either token A or token B will be shocked, and the size of the shock will be beta. I mean, one could generalize this to other distribution, but the main trade-offs will not change. The other event that can happen is that an investor comes, and this investor will come with probability, which is not K high here, and it could be either a type A or a type B investor. So what's the difference between type A and type B, and what does it mean? It essentially means the preference that you have for holding this token. Let's say Jiguo might like to have Ethereum token because he wants to run some applications, some DeFi applications on blockchain Ethereum. Will might like non-fungible tokens, so he might want to get B20 tokens because he wants to claim ownership to NFT collectibles. Fad might like Bitcoin tokens. So it really depends on the preference that you have. So if you have a preference for one token, then you get this alpha additional benefit from holding it. So that's essentially the private benefit parameter is alpha. So you are getting the price of token A times 1 plus alpha to capture the benefit of using it on the platform. Now, what is interesting is now what happens in the third period. As I mentioned, there are 2 kinds of arbitrage, and these arbitrage are essentially due to this deviation between the spot rate, which is given by the derivative of the AMM pricing function within the AMM with respect to token A and token B, and the fundamental rate, which is due to fundamental shocks that are happening to the tokens. Okay, so first type of arbitrage is what we call the stale price arbitrage. What does stale price arbitrage mean? It means that if there is a shock to the fundamental exchange rate of the tokens, while there is nothing or no shock happening within the AMM, because the price within the automatic market maker only depends on the reserves of token A and token B, and nothing has happened there. Then, of course, there is an arbitrage that can get exploited, because if one token has become more valuable, then you can swap it at a more favorable price within the automatic market maker, where the spot rate has remained unchanged. Okay? The second type of arbitrage is the reverse trade arbitrage. So that means that it's basically the opposite. In this case, there has been a change in the spot exchange rate, for example, because an investor has traded. So the slippage basically moved the price of token A and B to this new rate, which is the blue circle. And now there is an opportunity for an arbitrage to execute a reverse trade and basically earn the spread. So that's like the second type of arbitrage that can be exploited. Now, this competition between the arbitrageur and liquidity providers is really what is the key insight that we want to highlight in this paper. Essentially, the profit of the arbitrageurs is the loss in liquidity value for liquidity providers. So it's like a transfer of wealth from the liquidity provider to the arbitrageurs. Now, an arbitrager is maximizing his profit, so it's basically deciding how much to trade in terms of token A and B, so that he will be able to maximize his profit net of the fees that he's paying for executing his arbitrage. Okay. So suppose that after solving this optimization problem, pi is the value of the arbitrageur. So now, by competition, both arbitrageurs will beat pi, right? Because that's exactly what the profit that they are making. But this adverse selection cost is being split among all the liquidity providers, right? Because the liquidity providers, basically the arbitrage is basically the arbitrageur is arbitrage against the entire pool. But each liquidity provider only has a share of the pool, so a share WI, which is more than one. For example, if there are two liquidity providers, each holding the same share of the pool, that means that each of them will only be willing to beat half pi, right? Because that's how much they are losing if there is an arbitrage. So that means that this arbitrage problem is really unavoidable because the liquidity providers have no incentive to beat higher than pi, right? So that means that because it's like a first price auction in the sense that at the moment where the arbitrage win, I can exploit the liquidity providers, so there is nothing else the liquidity providers can do. So this means that the arbitrageurs will basically extract their rent from the liquidity providers. And what we show is that there is a critical trade-off which is faced by the liquidity providers, because on the one hand, they want to maximize the revenue that they get from the fees paid by the investor. On the other hand, they want to minimize the rent that is being extracted by the arbitrageurs. And what we can show is that if the size of the shock to the price of the tokens, so the fundamental shocks to the token, is sufficiently large, so larger than a specific threshold, there could be a liquidity freeze, which means that none of the liquidity providers has any incentive to deposit. Precisely because, like, if they do so, then the rent that will be extracted will be larger than the fee that they are getting. And this threshold, this liquidity freeze threshold, will be larger, which means that liquidity is less likely to occur if there is a lot of trades for either private reason or because there is a large probability that the investor is coming. So if the investor is participating, if there is a larger trading volume, then this is going to reduce the region where we observe this liquidity freeze. Okay. And if the liquidity freeze is not an equilibrium outcome, then we see what we can show is that both the expected value and the variance of these gas fees that are paid by the arbitrageurs will increase in the size of the shock and in the amount of tokens that have been deposited by liquidity providers. The idea is that if there are more tokens, or if there is large volatility in the pairs, for example, if we look at more unstable pair compared to stable pair or pair consisting of stable coins, then there is more rent that can be extracted by the arbitrageurs. And as a result, the arbitrageurs are willing to bid more because they can basically extract more profits from the arbitrage. What is a consequence, which is typically me? This is not highlighted too much in academic literature, but I think it's very important that if you raise the transaction fees, then you are imposing negative externalities on other users of the same blockchain, right? Because, of course, they will have to pay gas fee and in order to be competitive. And this is also partly motivates also the need for looking at sharding, et cetera, on the blockchain to prevent exactly this mechanism for fraud. So now I want to conclude by discussing the convexity of the pricing curve. Why does it matter? So we look at like a special case where we have two functions. One is the linear function where there is no slippage. So you basically trade is completely cheap. You don't pay any cost for trading. The other is a convex function, let's say the constant product market making function of Uniswap. And then we look at a convex combination of these two curves to see basically what type of curve we should choose in order to minimize the impact of this arbitrage rent. The idea is that larger convexity means larger slippage, so more expensive to trade. So what do we do? On the one hand, if we have a very small convexity, so the function is close to bilinear, then there is a lot of arbitrage rent that can be extracted, but the investor is also trading more because of low slippage. So on one hand, more profits can be extracted by the arbitrageurs because it's very cheap to trade, but on the other hand, you get more revenues from the fees coming from the investor. Second is that if there is large convexity, then the slippage, the price impact is large. So that means that the investor is not trading much, but it's also true that the arbitrageurs will trade less, so they will extract smaller rent. So there is a sweet spot, which means there is essentially a point in this convex pricing curve where the expected payoff of the liquidity provider is maximized, so it's the maximum. And as a result, this means that the occurrence of liquidity freeze is minimum. So I don't have time to discuss the empirical implications, but what I want to say is that we have basically tested or verified these model implications in the data using data from Uniswap and SushiSwap. And we have found that the pattern that we predict are essentially confirmed by the data. We see that like deposit inflow, which is the amount of flows deposited by liquidity providers, are decreasing with the volatility of the exchange rate and increasing with the trading volume, exactly as the model predicts. And these predictions are both economically and statistically significant. In the paper, we describe exactly how much a standard deviation increase in volatility of trading volume impacts the standard deviation increase or decrease for the flow rates. We control also for entity and fixed effects, so the results are quite robust with respect to that. And the same is true for the negative externalities, in the sense that if you look at gas fee and gas volatility, we see that this decreases if we compare stable pairs versus unstable pairs, which means pairs of stable coins versus pairs where one of the two crypto token is not a stable coin. We see that for stable coin, both the volatility and the price of the gas fee goes down. And this leads me to the end. Basically, the main punchline is really that the design of the AMM, based on the pooling of liquidity provision and the blockchain order execution mechanism, causes basically this unavoidable arbitrage problem, which basically means that the liquidity provision might go down, especially if the token exchange rate is very volatile, and it will go up only if there is a large volume of investor trading. So this is basically causing negative externalities on other users on the same blockchain. And if you want to mitigate or partially control this arbitrage problem, one has to look at the design function of the automated market making function. Yeah. Thank you.
So I would first want to thank the conference organizer for inviting me to read this very interesting paper. So what I'm going to do is to first give you a high-level overview about what this paper does. So in my opinion, I think this paper makes a very compelling point. And on the other hand, this compelling point is also very intuitive. So at the high level, what this paper does is basically pointing out this trade-off, that for liquidity providers in those automated market makers, on one hand, they get income from the trading fees that liquidity demanders pays to them. And what this paper points out that there's also another cost to providing liquidity. This cost happens when the underlying asset prices changes. And when those asset prices changes, gets arbitraged away by arbitrageurs. So in the next slide, I'm going to give you more details about why like this potential cost to the liquidity providers would happen. But for now, let's just take it for granted and trust that result, and let's see what the rest of the paper tries to say based on this relevant trade-off. Based on this particular trade-off, then those costly losses may deter liquidity provision, right? And in the paper, in the extreme, that if this cost is too high, and if this cost is just higher than the fee that can be obtained from to liquidity providers, then there's, in this paper, it argues that there could be a so-called liquidity freeze, in the sense that no liquidity providers will be willing to deposit tokens into the AMM, and so there's not going to be any liquidity provided at all. Okay? So if we do not take this extreme view, we'll just look like, okay, if there's still some liquidity provision being conducted, what will happen? So the amount of liquidity provision still is going to be impacted by this trade-off. So on one hand, if there are more demand for liquidity, right, that means that the fee income to those liquidity providers will be higher. That will naturally drive the amount of liquidity provided to go up, right? So this is the first bullet point here. And the second bullet point is that if the price change or the volatility of the underlying asset is so large, so that it's very easy for the liquidity providers to be arbitraged away and incur those costs, then the amount of liquidity provision will go down. And the paper then provides empirical support for the last two bullet points that I just mentioned, right? So at a very high level, this is a compelling and intuitive idea. Okay, so now at this slide, I'm just going to give you more details about why this particular cost for providing liquidity can actually happen, right? especially for the audience who has not been thinking too much about automated market makers. So I'm going to just provide you a very simple numerical example so you can see exactly what is going on. So let's think about, I'm thinking about a very small automated market maker between two assets. One asset is Polygon's Matic token. Okay, I chose it because its price is currently around $2. Okay, and I have another asset, which is DAI, which is a stable coin, as mentioned in earlier papers. And a stable coin, supposedly, in the most of the time, right, the price is going to be around $1. Okay, so let's think about a very small automated market maker. So there are 10 liquidity providers, right? Each of them deposit one Matic token and two DAIs to this automated market maker. So then the total liquidity provided, or in the jargon is like total value locked, would be 10 Matic token and 20 DAI. Okay, and this would imply a price for the Matic token as $2. Okay. Now suppose that there's a shock to the fundamental value of the Matic token. Like crypto markets are very volatile, so if the token just now drops price to $1, right? Now think about what the arbitrageurs would do, right? From the arbitrageurs' perspective, they know that on one hand, the fundamental value of the token has changed. But on the other hand, the price implied by the amount of liquidity provided on the exchange is stale, and it still implies that the token is trading at $1, right? So if the token price drops, what kind of is the rational thing to do? You are going to try to exploit the stale price, try to sell the Matic token on the automated market maker, and then potentially you can offload it on other venues, right? So in order to exploit the stale price, right, we can think about one example in which the arbitrageurs, they are going to sell this amount of Matic tokens, and then in exchange for getting back this amount of DAI. Why choose this number? So that this so-called bonding curve of this automated market maker is still going to be satisfied. Okay, so we can immediately see that, right? Because that now you sell this number of token, and the token is priced at $1, and you get this amount of DAI, right? So immediately for the arbitrageurs, they can pocket in a net gain from doing this arbitraging activities. And where does this gain to the arbitrageurs come from? All these gains comes at the cost of those liquidity providers, right? So that we kind of illustrates the point that for liquidity providers, if you provide liquidity on an automated market maker, if the price changes, you're potentially going to incur losses. And this is a quite well-known phenomenon in the automated marketplace. And actually, there is a name for that. Like people in the community call it impermanent loss. There are different ways of explaining why they come up with this kind of bizarre name. One way for me to view it is that if you think about if the price of the Matic token goes back to $2, right, this loss will actually be reverted. Okay, so you can do. Of course, there's going to be some small adjustment to the trading fees. Okay, so we see that the cost to providing liquidity on the automated market maker can actually have a very natural analogy with what we see on centralized exchanges. Right? So if we think about make a comparison between automated market makers and those familiar centralized limit order books, we can see that these providing liquidity to automated market maker is somehow similar to basically putting passive limit orders on a centralized exchange, right? And you can see, for example, if I provide just a liquidity, I say I offer to buy this token at 99 cents and sell it at $1.01, right? But you can immediately see that you will lose out if the price, the fundamental value of the price moves out of your bid and ask spread, and if you are being passive, so you do not withdraw your liquidity in time, right? So, to a certain extent, we can also argue that this phenomenon this economic mechanism may also kind of may deter liquidity provision in centralized market, right? So the liquidity providers may either just do not submit limit orders on those centralized exchanges, or they may just widen the bid-ask spread in equilibrium. So I think in this sense, there could be a close analogy that we can draw between those automated market makers and these traditional centralized markets. And I think this is a point that is worth mentioning. Okay, and also by drawing this analogy, we can also help us clarify what I think are some key differences between automated market makers and traditional traditional centralized exchanges. Right. So one aspect is we can see that, like in limit order markets, right, submitting orders or canceling orders, there's no direct cost to it, right? You only pay trading fees when a trade actually happens, right? So that means that if you are attentive enough, you constantly look at how the market has been evolving and adjust your liquidity provision and canceling, you may potentially not be subject to any losses, right? But this is not the case. But this is not the case in automated market makers, because when you provide liquidity, you're actually depositing those coins to the automated to the AMMs, and you are already going to incur gas fees, right? And when you take liquidity out of the pools, you're also going to incur incur gas cost. So I think the kind of, at least at a very superficial level, the one difference is that a centralized market liquidity to provide provision does no direct cost, right? But in automated market maker, it has a direct cost, right? I think it's kind of worth mentioning about this. And second, the fees paid to liquidity providers in centralized market are more flexible, right? So you can adjust your bid-ask spread. But at least in the version of the paper, in the version of the Uniswap protocol that this paper is based on, this is not actually allowed. Okay, so in this sense, like in centralized market, if order canceling is in time, then there's no direct liquidity provision deterrence. So I think making this analogy and kind of articulating the difference between these the new automated market maker and the traditional centralized markets that we are more familiar with is going to be helpful for a general audience to understand the results here. Okay, so my summary so far is that I think in terms of the paper's contribution, I think what I think is helpful, interesting from this paper is that it articulates how liquidity demand and asset volatility may affect the amount of liquidity provision in this context of automated market makers. And I think there's a beautiful analogy that we can make to centralized order, limit order books, and also the apparent differences. So I would suggest the authors to actually take a deeper dive along these lines. Okay. So also that not only doing this now would not only help us better understand the results here, but also may offer some fresh perspectives to some latest developments in automated market makers. So I'm just going to give you one example. Right? So just as with many DeFi projects, like things are constantly evolving. So if you look at the history of Uniswap this paper is based on, there has been three major milestones in the development of this product. So in November 2018, Uniswap version 1 came out. It basically was come out as a proof of concept for AMM, right? And then in May 2020, which is kind of in the middle of the crypto summer, and the Uniswap version 2 really become very popular and becomes the basis for the model and all the data for the empirical analysis in this paper. And last year, in May 2021, Uniswap actually come up with a new version, which is called Uniswap version 3. And what the major tweak that version 3 did to version 2 is that in version 2, the bonding curve is basically like, for example, x multiplied by y equals to a constant is like a curve like this. So you can kind of support all different price ranges. Right? So what the version 3 did is that it kind of breaks these different price points into buckets. And then within each bucket, your bonding curve will actually be like this. So what it does is basically allows the liquidity providers to allocate liquidity within different price ranges. And also Uniswap 3 allows multiple trading fee tiers. So to allow more flexibility, right? So, and we can see that from the data, like look at the trading volume, the Uniswap ever since its development, the volume of Uniswap version 3 is actually now actually higher than for version 2. So this is for trading volume, but I think a similar chart can be done for the total value locked or just the liquidity provision, the total amount of liquidity provision. Okay, so I think now if we make an analogy between the automated market maker, for the analysis done for version 2, and make the comparison between with the centralized market, we can actually also shed some new light on the design of Uniswap version 3. Right? I think that would add a lot of appeal from the analysis here to what is actually happening in practice. Right? So the stated rationale from the Uniswap development team of why they developed version 3 is that they want to preserve capital efficiency and allow more flexible fees. Right? So I think some of the fresh insight from this paper is that having a version 3, it gives additional degrees of freedom to maybe potentially help boost liquidity provision, and to a certain extent overcome the limited adoption problem identified for version 2. And also, it linked the price range choice in those automated market makers directly to bid-ask spread choices in traditional limit order markets. Right? And if you make the analogy between centralized market and automated market makers, they may also help toward this direction. And also, when asset volatility changes in a centralized market, the rational thing to do is to adjust your bid-ask spread. Right? Now with version 3, you can actually adjust the price range, which seems to have a similar role as responding to asset volatility. Okay. So, and then the fees maybe actually be something to adjust for the gas cost, okay? So I think I don't have any extra time. So just one quick word. The paper talks about a lot about the convexity choices, which I think is an excellent point. And it seems to suggest that's a design choice, but it may be also my suggestion is maybe you want to interpret it as actually market conditions rather than an exogenous design choice, but rather than endogenous market conditions, just because the amount of liquidity provided is actually endogenous. That may affect the convexity of the bonding curve. And the fact that this is endogenous may actually manifest itself further in Uniswap 3. So overall, I would say that I think this paper, as I said, I think it has a very clear and robust mechanism. It's verified in the data. And I think my suggestion to the author is that to make a closer connection with the traditional centralized market, not only will help this paper's result to reach a broader audience, but will also help to shed some light on some new developments in this space. Okay, that's all.